Hello and welcome to another Property Solvers podcast. This is Ruban Selvanayagam from Property Solvers. I'm joined by James Durr, also of Property Solvers. And
Hello, everybody.
Hi, James. How you doing?
I'm good. You, Ruben?
Yeah, I'm all good. I'm all good. Okay, so today we titled the podcast "Buy and Hold, Sell or Trade," and we're probably going to split the podcast into about three different parts. The first is kind of looking at buying and holding property, i.e. purchasing, retaining and renting the property out. The second is kind of buying to sell. So typically buying a property, refurbishing it, and then selling it back on the open market. And the third one is to trade, typically through auctions or through an estate agency sale. So let's start with buying and holding, and that's primarily what both of us started with. James, what are your thoughts on kind of buying and holding property in the current market?
Yeah, well, first of all, Ruben, hello everybody listening. It's a bit of a long title, this one. I mean, and it's probably because there's so many things to consider right now. In the current market. As you said, I mean, both of us started holding, buying and hold, and obviously the interest rate environment was a lot different than it is today. So at the moment, you've got interest rates. They're typically up around sort of early sixes, maybe mid fives if you're getting good rates. And obviously, I mean, rents have went up. I mean, that has been one of the sort of good aspects of the market recently. I mean, and one of the only advantages to inflation for us is that rents have went up. But obviously, the difference between rental yields right now and what mortgage rates are actually quite slim, and a lot slimmer than they were obviously when base rates were down at 2% or whatever. I mean, on most of our mortgages at the moment, Ruben, obviously we bought a lot of our buy and holds back in sort of between, let's say, 2003 and 2008 is when sort of we bought the majority of our portfolio. And we were on sort of old MX rates, Mortgage Express. I'm sure sort of old investors who are, let's not say old, but have been in the game a while.
You say old.
Will remember the Mortgage Express days when it was very, very easy to get a mortgage and you could refinance on the same day, and it was a really, really easy way to scale your business back then. But a lot of people who got those mortgages, they had overhangs of like base rate plus 1.75 or 2%, something like that. Yeah. Which means real rates that we're paying at the moment are somewhere near sort of 7%. And obviously, I mean, even if you're getting extremely good yields, let's say you're getting double-digit yields, like where we buy or where we were buying traditionally in Sheffield and Derby, and you're getting 10% yields, and your mortgage rates are 7%, that margin is quite slim. And if you add to that, obviously, Section 24, which for those who don't know, meant that you could no longer offset all your mortgage costs against your rental income. It's meant that a lot of these portfolios are now really struggling, or even sort of negatively geared right now with the combination of the double whammy of Section 24 and interest rate rises. So, I mean, that's really led me to, certainly as a strategy at the moment, I'm selling down my old portfolio. I'm still buying though, right? So I'm selling down my own portfolio, cutting debt that side, building cash flow to then buy sort of discounted properties in the current market, but more through a limited company. That's... sorry, go on, Ruben.
Yeah, I was just going to say, I mean, one of the advantages of, there's a lot of downsides that have kind of appeared over the last couple of years for people that were buying let's say from around kind of 2004 to around 2008, and there was a lot of buying happening in that period, because it was just possible to just purchase properties, get a one day, was it a daylight bridge they called it?
Daylight bridge,
daylight bridge, and then just refinance instantly. It was a crazy time in the market, actually. I don't think will ever happen again. But one thing that is advantageous about that is that quite a few people have accumulated a lot of equity since that period. I know Midlands and the North, they obviously didn't see that capital growth that you had down south, but in recent years, for example, around COVID time, there was quite aggressive growth. So there have been some quite decent equity gains over the years. So in that situation, and you're selling, like myself and James are, you do have that on your side, the fact that you've accumulated quite a lot of equity. But your tax bill to kind of handle all of these kind of situations is pretty high at the moment, and it's just a very difficult environment to operate in if you're owning properties in your personal name. So what would your feelings be on buying and holding in the current environment? So let's say, going out there at auctions or direct to vendor marketing and buying properties to actually hold in the current market. I mean, do you still feel that it's probably tricky given that the base rate is still quite high, and therefore swap rates are, and that's leading to still quite high mortgage pay rates on buy-to-let finance at the moment?
I mean, obviously it always depends on where you're buying in the country, and obviously some places and what strategy you're using, right? Because some people are into HMOs, maybe commercial property, where they can get yields of 15-20% in some cases. So obviously for those people, if that's what you're buying, then by all means, you can go out, buy and hold. Now it's not an issue. But what we're talking about here is generally standard sort of vanilla buy-to-let. And with buy-to-let, at the moment, at least our strategy is, we're buying properties, but we're typically trading them. So trading is when you buy a property below market value and then you sell it, sometimes without doing any work. I mean, we do that sometimes. We'll flip properties through our auction. So it's kind of like an arbitrage. We'll buy it on one market, flip it through another, and we make profit that way. Some of them we'll buy, refurbish and sell. But there's very little that we're buying and holding. And the reason for that is because, at least in my opinion anyway, I feel like we're in quite a shaky market at the moment. I do see prices dropping over the next 12 months. And obviously my view is when interest rates are high, margins are slim on rentals, with the possibility of prices dropping, so asset values dropping. I don't see the point in the short term, when obviously cash flow is very slim on these properties. I don't see the point short term of buying and hold. So like I said earlier, my strategy for the current market is there are opportunities out there. I mean, there are lots of landlords selling. So, it's a double-edged sword. There's landlords selling, obviously there's homeowners selling. These interest rates, like a lot of people coming off sort of long-term fixed rates. And so, there's opportunities there to pick up some good deals. And we are actively buying, but we're buying in limited companies, number one, so we can avoid the Section 24 tax implications of owning in your own name. So that's a big one. And the properties that we are buying, we're typically selling, or we're trying to limit our exposure to as short a time as possible on the market through, maybe if we can do it, just flipping them straight through auction. Maybe the margins might be lower, but it's about volume if you're trading them through auction. So that's a strategy that we're utilizing quite a bit at the moment. And just one more thing. I mean, on the tax side, obviously when you are selling properties, and you're right, Ruben, like a lot of these areas like up north, they have seen a boom in the last few years. I mean, they were stagnant. Like at one point in like sort of up in Sheffield with my properties, I was wondering, are these bloody houses ever going to go up in value? You know.
Yeah.
But the last few years, let's say since, I don't know, let's say 2018, maybe particularly, like the North has seen, and by the North, I mean the Midlands as well, has seen like really good growth. And most of those property prices have more than doubled, in my case anyway. So obviously when you are selling, like you can release big chunks of equity, but obviously you're also getting tax like capital gains tax, which is 28% for a higher rate taxpayer. So obviously you got to manage that as well. So, you know, you're getting caught on the way out as well with tax. And obviously, you know, like when I started buying properties first, my strategy was long-term buy and hold because I'd never have to sell. I'd never have to pay capital gains tax, you know, and obviously when you remortgage, you're remortgaging debt. So it's not something that's taxable. And you can basically own those properties till you die and never pay tax. But obviously with the way that like the whole game changed with Section 24, which came in, I think, in 2015 under George Osborne, since those tax changes, it's completely changed the game in terms of like owning property in your own name. And now like it doesn't make as much sense as it did previously when everyone bought like that. So you just got to manage that process. If you got old property, like if you got like legacy properties from back in the last boom, and we're just managing the exit of that, paying the taxes, rolling the money over into a limited company, and rebuilding. Well, our plan is to rebuild a portfolio once interest rates ease, because obviously when interest rates start dropping, then you know the margins widen again between what debt you're going to be paying on your mortgage and what the rents are, and then suddenly like buy and hold becomes a strategy that makes a lot of sense because you're also, you know, you'll be at a lower point in the property cycle, maybe sort of towards the bottom of the market. And our plan going forward is to buy and hold substantially like over the next few years, once interest rates ease off a little bit.
Yeah. I mean, they're going to ease off, in my opinion, anyway, but I don't think they're going to ease off majorly. So I think we've all got to get used to this new kind of high interest rate environment, you know, and also, you know, the game of property investment, property development has changed quite a lot in the last couple of years, and it's probably been one of the like toughest times I've had to operate in. You know, and I think the kind of when I first got involved in property, there was a lot of discussion around kind of no money down investment, you know, buy, refurbish, refinance, rent, pull your money out, put it back in, momentum investing, all these kind of little phrases were flying around. And I just think, I'm not saying those days are over because it's certainly possible to do those kind of deals. It's just a lot harder, you know, to be able to do a no money down deal, for example, these days. Really, I wouldn't say it's impossible, but you've really got to be buying a very low discount, you know, which is possible, you know, definitely. But it's just very
Do you mean no money down by like, I mean, you can do no money down if you just buy a discount and then refinance after 6 months.
Yeah, I mean, my issue with that is we've seen it ourselves. You know, we've bought at what, you know, or what is a below market value price. We've refurbished the property, tried to refinance it, and then what's happening is the lenders are going out there and basically kind of seeing what the property is being purchased for, and then automatically down valuing the property. You know, the only way I think it's kind of working at the moment is for the guys that are going out there and doing commercial type projects. So they're buying and, you know, maybe buying a house or, you know, a part commercial building and converting it into, you know, multi-let or HMO or something like that, then refinancing it onto commercial finance. So it tends to be looked at differently. I think the kind of
Yeah.
refinances is a bit are very difficult to do, even for low money, Dan. So I think you're going to be putting in leaving quite a bit of money in, But if that's your strategy, it's all good, As long as the deal stacks up, if you don't mind leaving some money into every deal, you're still going to get a decent return on it. And then you're using it as a bit of a long-term play where you're just kind of like, well, okay, I'll just hold on to this property. I've refurbed it. I'm not going to have any issues with it over the next few years. No complaints from the tenants or anything like that. You can just kind of just let and forget almost, and just kind of just let it do its thing, and then long term you're going to be gaining, So some people, that's a fairly common strategy for people who just want, to build a hassle-free portfolio, for example.
Yeah, I think surveyors in general are probably down valuing at the moment, like they've been told by the banks, basically the market is a bit toppy, like value conservatively. And if they see an opportunity to down value, if they see that it's been bought recently for a lower price, like, I mean, I've even had properties that I'm selling on the market, like one recently where I had multiple offers at 115,000. It was a rental up in Sheffield that I was looking to get rid of. And the surveyor came in and valued it at like 100 grand, and this is a property that I've owned for years with multiple offers on it at 115, and the sale ended up falling through. I put it on the market again. I actually got 110 for the next time. A surveyor came in, down valued it again at like 105 or something, I ended up having to take a hit on the property, like even though I'd effectively sold it at whatever the market decided it was worth twice, but it got down valued by surveyors. And yeah, I mean, I think that's part of the, like, what you got to deal with at the moment with the market,
Yeah. And I think,
but in terms of,
yeah, sorry, James.
I mean, in terms of refinance and no money down stuff, I think that the main stumbling block at the moment with pulling your money out is just the rental cover needed at these very high interest rates.
Yeah.
And I think that's a challenge more than like surveyors down value in the current market. I think just like to be able to get these properties that you're buying, like to stack with rental coverage and pull your money out at these high interest rates is difficult,
Yeah.
And for us, like, these are all the reasons why we just feel like just the strategy for right now is still buy to sell. And I mean, it is transitioning into a buyer's market, and it is getting a little bit more difficult to sell, but it's not like the market is not in like capitulation phase or anything, So like you can still, like, if you price a property right, you can flip these properties and make good money.
Yeah.
So why not just take what's on the table and then build a pot for when interest rates drop, and then like you can buy all the properties you want to hold and build your portfolio in a more favorable interest rate environment. That's my thoughts.
And one where the capital growth prospects are a little bit stronger as well,
Exactly. And instead of potentially, like, obviously nobody can predict the market, but like, when interest rates are so high and like the economy is slow, and obviously we had a technical recession that just ended recently. I mean, is your prospects for capital growth on the horizon, are they looking that great at the moment? Or do we think, like, with the economy slowing, with so many people coming off fixed rates and the interest rates being high, and obviously overhangs on these mortgages being even higher still, like, there's a lot of headwinds for the property market right now.
Yeah. I think when you're looking at deals and you're looking at potential projects, always think conservatively at the moment, because that's how surveyors are thinking. We've seen ourselves, with properties that we've refurbished and tried to sell. Even, we've done, to stroke, pat ourselves on the back. We've done quite decent refurbs, and they're still coming in and down valuing it. So it's happening left, right, and centre from what we can see. And so, buy to sell, James. What are your thoughts on that? Basically what I was just talking about. Buying the properties refurbishing them and selling them. What are your thoughts on that in the current market?
At the moment, if I can stay away from refurbing, I will. And there's a couple of reasons for that. One is obviously build costs have just went through the roof recently. Like refurbs that we were doing for like 20 grand a few years ago, like let's say 6-7 years ago, are now costing us 50 grand. So there's that. And there is the other thing about refurbs is shit. I can't remember what I was going to say.
Is it like actually selling these properties?
Oh, that's what I was going to say. So the other thing about refurbs right now is like I want to limit my exposure to the market, and like I don't want to take on a refurb that's going to take me, let's say, 10 to 12 months. Like let's say a big refurb, like an extension, a side extension, a back extension, when the market is shaky and when like, you know, build costs are kind of a little bit out of control. So personally, I am staying away from refurbs as much as I can, but that's because like we've got a real edge, Ruben, what we do, because obviously we're set up to buy below market value property. We've got our own auction business and we can trade, like we're property traders. So like it's a strategy that not all people can do. But we're set up for that. So that's our favorite method of disposal at the moment. But look, if you're a developer or you're coming across deals, like, I mean, you can still make extremely good money refurbishing properties. And like, I mean, let's say on my rental properties, like my rental portfolio that I'm selling down, I'm still refurbing them, you know, because that's got like two advantages. Like the one is that obviously when you refurb it, like you've got less taxable expenditure. So again, going back to like the Section 24 stuff, I can bring down like my taxable revenue. So that's one advantage. And the other advantage is obviously you're forcing the value up. So you're kind of winning both sides. So definitely like those ones that I'm selling, I'm refurbing. The ones that I'm buying like straight away through a limited company, I'm still doing refurbs, but I'm trying to, if I can, trade them without doing work and limiting exposure. So
another advantage of refurbing these properties, you know, particularly if you've got a tired rental property, there is arguably a bit of an oversupply of properties on the market, particularly these properties that are coming on from, you know, landlords that are selling up due to Section 24 or just not wanting to be a landlord anymore. So there is a bit of an oversupply, and the quality of the stock that's coming on the market isn't great. So if you do refurb and then you put it on the open market, you're going to stand out a little bit more from the pack, you know. So that is an advantage. But
you just got to watch sorry to interrupt, but just on that point, I mean, you just got to watch as well, because sometimes like the actual cost of a refurb like is probably like in some cases it's not even worth it. So let's say like you've got a property that's coming up like it's coming empty and you want to sell it, and let's say in its current state, for example, it's worth 120 and it needs a 30 grand refurb, and after it might sell for 160. That is the case with some properties that we're disposing of. And if the margin is too low to not bother, I'm just going to list it as it is and just sell it, you know. So that's another thing to watch out for. Sorry to interrupt you.
No, that is true. I mean, one way around that is to just test it on the market. You know, if you wanted to get in touch with us, we can potentially put your property on the market either through our 28-day or 56-day auction or through our estate agency, and we can just see how the market reacts. That's what we've been doing. And if we're getting a lot of interest, a lot of viewings, then we know that, you know, we don't necessarily have to refurb it, and we can just sell it, move on, pay the capital gains, do whatever needs to be done, you know. But yeah, it just depends on the property, I guess, and how the market reacts to it. You know, there's a lot of properties that were bought in the time that we were buying, James, where, you know, they're really decent houses, family homes, you know. But then there are other properties that are a little bit suited to kind of buy to let, you know, they're in those kind of areas. So it really depends on where your stock is held primarily. It's just to kind of
I mean, that's another thing.
yeah. Sorry, James. Go on.
That's another thing that, like, when it comes to, like, what properties to sell off, obviously with the portfolio. I mean, I'm also trying to get rid of my low end stock, so that's the stuff that's getting liquidated first.
Right.
And
Makes
yeah,
sense.
just reduce debt on that. Like, I'm having to. It sounds crazy, but I'm having to reduce the rent roll. So I'm in a situation where I actually want to cut my rent revenue, which seems ridiculous, but that is the way that Section 24 has made most landlords think, because you're getting taxed on your revenue and not on your net profit.
Yeah, yeah. And just to kind of end things with regards to trading, and that kind of activity, why do you think that's particularly advantageous at the moment? And doing that in the current market, why do you think trading is a good strategy?
I mean, by trading, do you mean like flipping on without doing work?
Yeah, essentially. I mean, at the moment there is in the circuit.
It's obviously, I mean,
yeah.
trading used to be trading, but now, like, people seem to be like calling, like, there's trading and there's flipping, and they're both different, which is kind of a
there's
new
also
thing, like,
there's also auction trading as well, which is going out and looking for auction properties that are priced really well, buying them or kind of securing them via some kind of delayed exchange and completion, and then just reselling them. My only gripe with that particular strategy is that if you're able to buy a property, below market value at auction, it's probably a sign that the auctioneer is not doing a very good job, and kind of not marketing that property in the best possible way. So I'm not completely convinced about that. I mean, maybe if you could buy one of these properties and there's an angle, where you can add value through planning or whatever, that's great. If you can find that and see something that others don't. But I think this strategy of kind of buying at auction and then flipping it straight away obviously there are people out there doing it and doing it quite successfully, but it's probably a sign that the auctioneer is not doing a great job in marketing the property in the first place. And if, say, for example, if I was a seller at auction and I found out a trader picked up my property and sold it on a couple of months later and made a decent chunk of profit.
I think, like, obviously, if you're an investor, you're just looking for opportunities, right? And I think, like, some of these properties, genuinely, they do stick on some of these small auctioneers sites, and, like, maybe like a lot of people don't like buying at auction number one, right? So, like, there's almost like a discount to a property anyway. Like, if you buy a property at auction, generally, like, you will get a discount just by the very fact that it's at auction, because a lot of people don't like it and they stick away from it. So, like, if you were an investor and you spot an opportunity like this, I mean, there's people who will buy a property at auction, pick it up cheap, and sell it through an estate agency sale, and we've seen ourselves, like, we did a property we listed recently that didn't sell at auction. We reduced it again at auction, it didn't sell. Then we put it on with our estate agency at a higher price and it went over asking price. Do you know what I mean? So there are these kind of nuances within every market, and, like, opportunities to arbitrage and to find value. And obviously, if you can find those deals and make money out of them, then, more power to you, as far as I'm concerned.
With that particular example, it was more, I think buyers were getting scared off with the word auction. It was quite a larger property and, probably perceived as a little bit risky. And then when you add the word auction to something, people will, some often think that there's something wrong with the property. That's why it's being sold at auction. It's kind of got that stigma.
People also sometimes they don't like the modern method of auction either, because they don't like paying buyer's fees.
True.
But the thing is, like, with modern method of auction, you can pick up some, like, really good bargains in the, like, if a property is being sold that way. And the one that I've just spoken about, would be one example, without giving sort of figures or anything. Like there would have been significant margin if somebody had picked it up cheap and flipped it on,
or even turned it into some kind of flats or a multi-let project or something like that. There's opportunities there as well with that particular property. Yeah. Okay, that's great. Well, any comments? Feel free to add them to we're on YouTube, so you can add comments there. Feel free to contact either of us on LinkedIn. We're very interested in finding out what you guys think of the podcast, what topics we should be discussing, and where we can be taking things. So feel free to get in touch with us. And once again, a big thanks for listening in. Appreciate it.
And don't forget to like and subscribe. Obviously, that really helps us out.
Great stuff. Thanks a lot, James. Speak soon. Take care. Bye.
Thanks, Ruben. Thanks, everybody. See you. Bye.